We 100% believe that stablecoin rails are going to be one of the kind of first class payment rails going forward for all sorts of use cases. But simultaneously, we don't think that the banking system is going away anytime soon, right? So it's really important for us to be able to bring both sides together seamlessly.
That's Tom, co-founder of Walapay, a money movement infrastructure platform bridging traditional banking rails with stablecoin-powered payments. With a background at ConsenSys, Tom has been at the forefront of Ethereum's evolution and now leads Walapay in reshaping how money moves globally. In this episode, we dive into how Walapay enables instant cross-border transactions, the role of self-custody versus custodial wallets, and how fintechs and PSPs can leverage stablecoins for speed, cost savings, and yield. Season 3 of Stableminded is powered by Dfns, the leading multi-chain wallet platform helping fintechs, banks, and enterprises manage digital assets securely. More than 130 global clients secure over $1 billion in monthly volumes through Dfns. Manage governance and compliance, automate workflows for approvals, and unify your APIs, all within a platform that has a perfect security record. Access a broad network of ecosystem integrations. From compliance tools like Chainalysis to exchanges like Coinbase, Dfns integrates seamlessly with all the tools you need. This season, we sit down with the co-founders of Dfns to dive deeper.
How we doing, Tom?
We're doing all right. Thanks very much for having me, Drew. Pleasure to be on.
This has been such a fun season. Dfns and Chris it's been really fun working with Chris on this season and the Dfns team because they have just really introduced us to some incredible teams and incredible guests. And you are one of them. So excited to dive into what you're building and how it relates to stablecoins. Why don't we start with your high level, your name, role, what you're building, and especially if you were to describe what you're building to a person who might just be getting going with this conversation about stablecoins.
100%. Excellent. So I guess we can start at the beginning, but essentially I'm one of the co-founders of Walapay. We are a money movement infrastructure platform, really centered around one API endpoint that lets our customers move money across any different currency. So it could be from a fiat currency all the way to stablecoin. And we are pretty agnostic to different rails. We try to integrate with local rail systems everywhere and really serve as a bridge between the banking system and stablecoin rails. And all of that is really facilitating cross-border payments and a bunch of different fintech use cases, right? And so I'm one of the founders of the company. I founded this company with my brother. We've been working together for a long time and have been working on Walapay proper for about 18 months. We just went live in September of last year. And it's been a very, very exciting period of growth over the last 4 or 5 months in particular. And this space is just exploding right now in terms of demand. And just working on a lot of different things with different customers.
Amazing. In this episode, I'd love to really dive into a couple key areas, just mainly around where you've been before this conversation and how you arrived at it. I know it's probably not a coincidence that you entered this space at the perfect time and have been building in it. I know that you have some interesting experience before this, but I'd love to maybe start with the relationship with your brother. It was interesting talking with Chris and Clarice from Dfns and just as a married couple being co-founder, what that's like. Maybe that's a theme of this season so far. Give us what's it like to start a business with your brother? How have you guys navigated that?
Yeah, no, it's a great question. We're very lucky, I think, that we've always had pretty complementary skill sets. So we're not trying to be at each other's throats. Like it's always been a very good rapport between us. And we've always had a shared curiosity around just trying different things, bouncing around different ideas and trying different projects together. So it's been a long time in the making. And when you look at what we're building today at Walapay, it really is a reflection of our lives and just our shared lived experiences, right? We're both obviously from Belgium. We grew up bouncing around between Europe, the US, Japan, now back in the UK on my side. And so as we were growing up, we were really exposed to a lot of the different kind of payment cultures in these different places that we were living in, right? And so we were exposed to that both in our personal lives, but also in our professional lives, working in different parts of the world. And being exposed to these kind of payment challenges, which are for us minor inconveniences in some ways, but we were always coming up against things like sending money back home from the US to Europe or Europe to Japan, for example. And even though they're inconveniences for us, they definitely expose some of the problems that exist in doing that, right? And that kind of planted a seed in us and really started our interest in solving payments challenges. And I guess that was one of the big reasons for us being, I guess, primed to have an interest in Bitcoin and later on Ethereum. And that kind of charted our path to where we are now, right? So I remember back in 2013, first finding out about Bitcoin. I was at the time just in my college dorm room, but really finding it to be pretty fascinating technology and finding it to be a potential way to solve some of these payment challenges. Now, of course, after actually using Bitcoin, it was, on the one hand, a magical experience, but on the other, it became pretty quickly clear that that wasn't going to solve the kind of payment challenges that we had seen. But it provided a lot of exposure to what would come later with Ethereum and then stablecoins.
Yeah, it's an interesting maturation process, or something that I've gone through myself as well. I definitely personally started, fell down the Bitcoin rabbit hole and wound up working in stablecoins, I think for the same sort of process. I think a lot of people who are now taking a very serious and professional approach to this landscape of stablecoins started originally looking at the foundation of Bitcoin and Ethereum. And maybe that leads a little bit to your role with ConsenSys. I'd love to know, you were there for 4 years during what I would consider like an incredibly pivotal time of that business. And maybe for you, I'd love to just hear what part of that experience specifically stood out to you as it relates to this conversation about Walapay, stablecoins, the current season you're in. What did you see? What did you notice during that time? During what most, for those who aren't maybe aware of, ConsenSys is one of the most like secretly powerful companies in Ethereum, crypto, the wallet space. Yeah, tell us a bit about that.
For sure. And just to build on kind of the evolution from Bitcoin, I think while Bitcoin was super interesting for me and my brother, almost from like an intellectual standpoint, it was really Ethereum that kind of cracked open the opportunity for us. It became super clear with something like Ethereum, where you have this permissionless blockchain, but where you can actually start building things on top, right? Financial use cases, fintech type of use cases. That was where the opportunity became super clear to us, right? Like now you actually have this ledger where you can build things on top and start maybe building payment systems. And so after the Ethereum ICO, I became very interested in the Ethereum ecosystem. And it became super clear to me that I had to get involved professionally in that ecosystem in some kind of way. And like you pointed out, ConsenSys was really foundational to that ecosystem. The founder of ConsenSys, Joe Lubin, who was also a co-founder of Ethereum, was pretty instrumental in forming the right place and the right venue for people to start working and experimenting with Ethereum, right? And so initially, Joe set it up as an incubator of sorts, where he basically enabled a lot of people to start building applications and infrastructure and obviously wallets in the Ethereum ecosystem, right? And so you had really pivotal projects like MetaMask come out of there, Infura, and a bunch of others that were really foundational to the evolution of Ethereum, right? And so I started there around the end of 2017. I was initially working very closely with Joe in a chief of staff kind of capacity. And I got to work with a lot of the different teams at ConsenSys, right? So including MetaMask, including Infura, and just having a purview across the entire portfolio of different projects that we had, right? And like you said, this period from 2017 to like 2021 was pretty chaotic, but really foundational in terms of a lot of the core building blocks of Ethereum, right? So you had one of the earliest, like super exciting projects in Ethereum that really caught my attention was DAI. So the whole maker ecosystem, the first kind of completely decentralized stablecoins were starting to come out at that time. You had the maturation of certain wallets and just a general maturation of the infrastructure that eventually led to the merge and things like that, that made Ethereum much more usable for many different things. And so when I started at ConsenSys, building stablecoin based payment systems was still very, very complicated, right? Both from a technological standpoint, but also from a regulatory standpoint. The technology just wasn't quite there to support highly scaled up payment systems. But even more importantly, the regulatory landscape wasn't quite there in terms of enabling financial institutions and other types of payment institutions to really use stablecoins as a core method of payment. And so I spent about 4 years there. In the end, we actually restructured ConsenSys from an incubator to a technology company. I was part of the team that made that restructure happen. And then coming out of that, spent a lot of time in the corp dev team doing a mix of investments, acquisitions, et cetera. And that basically gave me a pretty wide purview on the whole ecosystem. And eventually that's what led me to leave ConsenSys to start building on my own with my brother. And that's what led to Walipe.
How long, I guess for you've talked about obviously the incredible depth of time that you spent working with Joe and ConsenSys in the Ethereum community. I was something recently, just as we're thinking about our business at Stable Studios and the core products that we're thinking about building, stuff like the content we're putting out, we've been really excited about just the future of what stablecoins look like on Ethereum networks, but also Lightning. I'd be curious to hear as you build Walipe, and you can get into that next, but on the topic of Bitcoin, Ethereum, your story, what's your take on stablecoins built on Lightning, for example? What do you think about that?
I would say that first and foremost, the way that we look at this is very much from a payments and solving customer problems lens first and working our way back from that, right? So in many ways, we're pretty agnostic to the blockchains or like the blockchain or protocol layer that we use, as long as we see that A, it actually works, right? And B, that you have the support ecosystem around it to make it useful in payment contexts, right? So when I say the support ecosystem, is there the right developer tooling? Do you have, for example, wallet infrastructure companies like Dfns that are supporting those kinds of networks and chains? You need a certain amount of infrastructure to make this useful for the end customer, because at the end of the day, that end user that's getting paid in an emerging market, or that company that is using your platform to do supplier payments or this kind of stuff, they're not really going to care what underlying blockchain is being used to power this, right? So that's number one. Now, more from a kind of, I guess, conceptual point of view, we're pretty open to trying out different blockchains and seeing what are the benefits that we get from each. I obviously come more from this Ethereum EVM background, but we absolutely, for example, use Solana and we use Stellar. And so we're open to using other blockchains, especially depending on what kinds of use cases we're trying to achieve, right? I think the Lightning Network has potential, and we've been in touch with companies like Lightspark that kind of operate in this ecosystem, and we absolutely view it as one of the potential underlying rails that we can use. But I would say that in terms of where the customer demand is taking us, it's been primarily on these more general purpose blockchains like Ethereum, the layer 2s, and Solana.
Let's dive into Walipe and what you're building. Give us an overview. If you were to go to, I would imagine you probably have two specific types of counterparties that you're selling this business to. You're talking with, you have the financial institutions who are a part of this system and the liquidity side of getting money in and out of those banking rails that you mentioned. But then you also have the the end platforms that are using, putting flow and volume through that system. Speak to maybe both, or if there's any other key participants in the system. How do you communicate the value of what you're building to each? Would love to maybe start there.
Yeah, great question. So first, let me iterate that what we are fundamentally doing is bringing together the banking rails and the stablecoin rails, right? We 100% believe that stablecoin rails are going to be one of the kind of first class payment rails going forward for all sorts of use cases. But simultaneously, we don't think that the banking system is going away anytime soon, right? So it's really important for us to be able to bring both sides together seamlessly, right? And that means very fundamentally speaking with and actually working with a lot of banks and banking partners in different parts of the world to support a lot of the products that we're offering, right? Which are both bank accounts that we can issue for our customers and their customers. And then the payment side, which in many cases for us either originates or ends in a bank account, right? It could be going from a bank account to a stablecoin or vice versa from a stablecoin to a bank account. So on the infrastructure side, it's super important for us to be able to speak the same language as banking partners and other kinds of financial institutions that we work with to support the foundations of our infrastructure. And it's important to be pretty buttoned up around things like compliance, around money laundering, how we deal with things like transaction monitoring, KYCing our customers, et cetera. It's really important to basically have this kind of infrastructure in place to be able to work with the right kinds of banks all over the world, right? So that's on one side of things. And then when you look at who we are serving today, it's kind of a mix of businesses and platforms. So we do work with businesses directly who have cross-border payment flows. Maybe they're paying contractors in emerging markets. That's actually how we started at Walapay. But it could also be paying a supplier in China or in Vietnam as a company based in Mexico, for example, right? So that's kind of the business side of things. And then more and more, the types of customers that we are actually serving are platforms. And here again, there's two different types. One are the fintech companies, so a lot of consumer-focused remittance companies and neobanks, these types of fintech plays. And then on the other hand are PSPs, so a lot of the payment processors, merchant acquirers, et cetera, who handle a lot of flows on the payment acceptance side, right, on behalf of their merchants. And then from there, there's a lot of interesting things that we can bring to the table in terms of, one, instant settlement into multi-currency accounts, two, being able to repatriate funds in real time, or at least T0, to emerging markets. And then three, actually making some of those deposits productive in a way by converting them into yield generating stablecoins, right? And in that case, we can actually split the yield with the customers. And so for them, whether it's the fintechs or the PSPs, what we are bringing to the table with stablecoin infrastructure is speed, cost. So in terms of collapsing some of the FX costs that they may have, and then access both to the dollar, which is super important in these consumer-focused fintech plays, right? So you have a lot of companies like Dollar App or Zarpay or Decaf that are doing this today and actually providing dollars to their customers in markets where either their own currency is subject to inflation or just really volatile. And then you also have access from the point of view of the merchant or the PSP to emerging markets, right? That isn't super straightforward using more traditional kind of banking rails, but what we're able to bring to them is that direct kind of real-time access with local rail integrations into a long tail of markets across Latin America, Africa, and Southeast Asia.
I want to ask you, that's really interesting. I want to ask you about the wallet side of this. I think something that I'll speak for myself, I'm sure others may be asking themselves, is like, who actually pays for these wallets infrastructure companies? Like, who's paying the bill? I think the wallet as a service industry is an interesting, it got through an interesting moment of maturity right now. And like, some players are pivoting, others are doubling down. What I think is interesting about you guys is, from my understanding, with your relationship with Dfns, you actually have integrated a wallet infrastructure into your offering that you're then bringing. As someone who's spent a lot of time working and selling wallet infrastructure, and I think I'm uniquely interested in that space personally, give us an idea of where you see that fitting. Because I know Dfns, for example, as a wallet infrastructure company, could power a PSP or a payment platform directly in a sense where that platform could use a wallet infrastructure first party with them. I'm curious how you just think about that, and maybe to answer that, it would be helpful to understand how you use that partnership or what that looks like with Dfns today.
Yeah, for sure. I think we can maybe start actually with that. I think that the beauty of using and working with a company like Dfns is that they're able to offer flexible custody models. So we work with many different kinds of customers. I'll focus on the platforms because that's probably where it's more relevant. But if you're a consumer-focused fintech play that's operating on stablecoins, one of the kind of big advantages of using stablecoins and wallets is that you can actually have a self-custody model where a lot of the liability is removed from the operator, right, from the platform itself, and that the custody, the responsibility of that is with the end user. And that avoids a lot of operational and compliance headache for the platform and allows them to go to market pretty quickly. And so a company like Dfns is going to be able to offer those types of wallets to the platform. And we may offer that to the platform, but we're under the hood using a company like Dfns, or Dfns may go straight to the platform. Either model works for us. But what we can also do using Dfns is provide custodial wallets using Dfns, and then a qualified custodian that we work with. We can provide this kind of custody wallet that makes a lot more sense typically for the types of merchants that will deal with a PSP, for example, right? And having that ability to flex depending on the type of customer that you're working with, who may have different requirements around whether or not these wallets are named and actually who has the liability with respect to the funds in the wallets. Having that flexibility really allows us to cover different types of use cases.
For those who might not be familiar with like the named account versus omnibus account, maybe just speak on that for a minute, because and the regulatory considerations between those two, I think it's a really interesting model that most people don't see behind the hood.
Yes. Okay. So that's a great question. And the best way to think about it is who the customer is and what they need from a wallet and actually from a bank account, right? The big innovation in fintech and banking as a service, I guess over the last like 10, 15 years, has been using these FBO structures so that a bank through a fintech like a Synapse or a similar platform can start issuing bank accounts to end users, typically in the context of some kind of neobank like a Cash App or something of that nature. And that had huge advantages because a bank essentially could work with a fintech who has a lot of the distribution into new markets and issue bank accounts to those types of customers. And that operated under the for benefit of model, right? And essentially what that means is you have an omnibus account that the fintech will operate, and then there are a bunch of sub accounts essentially for each individual end user. That has benefits in terms of being able to launch that quickly and have essentially the fintech take care of the entire distribution side of things, right? But as we saw recently with the Synapse and Evolve kind of debacle, it has limitations as well, right? Because at the end of the day, you need to have some form of reconciliation between the bank and the fintech, and there may be different expectations in terms of how the compliance is done. The bank may expect some level of compliance to be done by the fintech that's offering these accounts, but then ultimately the bank is the one liable for issues that happen related to money laundering and KYC, KYB type of issues. So there are some limitations there. Now, what we have with our ability to offer named accounts as well as virtual accounts is we can basically differentiate based on the use case and offer these different types of accounts for our customers, again, based on what they're actually looking for. So a lot of businesses that we work with, they really want their own named bank accounts that are not FBO structures. They're actually full bank accounts that are dedicated and held under their name at the account, at the bank, sorry. And so that kind of allows them to have full ownership over that kind of account. And it moves a little bit the compliance and regulatory liability away from us in that case. And so that's on the bank account side. And then you can replicate this kind of structure on the wallet side, depending on whether you have a self-custodied wallet that's fully operating on a blockchain versus more of a custodied setup where ultimately it's the qualified custodian that actually has custody of the funds in the wallet. Hopefully that makes sense.
Yeah, absolutely. So it sounds like you can support both. You can support these highly regulated banking, more custodial models, but for maybe there's platforms or payments companies that once you use Dfns and Walipe in a more flexible way where they give the custody and the keys and the signing rights, and I'm sure I don't want to even go down that path because Chris will probably correct me immediately. But it sounds like there's that alternative path as well, which is great. I'd love to just pick an example of a flow that Walapay, I know you mentioned you started with contractor payments and that was sort of the leading use case. We could go with that one or another one, but I would just love to know, let's pick a business, let's pick even a specific one that you have that you like to use as a reference and just walk through a payment. And I'd love to just break it down step by step, like what's happening in a really simple way. So I'll let you pick what makes sense, but that'd be great.
Sure thing. So, and I apologize in advance, this is going to be a long one, but we're going to start actually all the way back to our initial kind of use case, and then I'll walk you through the evolution. But back when we started Walapay, we had to identify a particular niche or angle that made sense for us to start with, because as payments is such a massive industry, even something like B2B payments is still a massive, massive industry. So we had to find a particular angle to begin with. That's where, for us, when we thought about stablecoins and who could most benefit from them, the idea of supporting freelancers and contractors in emerging markets getting paid from typically companies that are based in the West, like Europe or the US, that was, for us, a very clear kind of gap and opportunity where we could begin with, right? And whereas I think a lot of folks and a lot of companies that even we support today started with the idea of supporting the freelancer directly through some kind of consumer-focused fintech app, we decided to actually focus on the originators of those payments, right? So the payrolls, the talent marketplaces, and these types of companies that are actually making the payments out to the freelancers, right? And so typically those kinds of talent marketplaces, et cetera, they will work with a PayPal or a Payoneer or one of these companies to make those payments out to folks. And what happens there is that typically these payments might take 4 to 7 days to actually settle, like end to end, all the way through to a bank account. And often, whether it's PayPal or Payoneer, they're charging something on the order of 2 to 4% in FX fees, right? So as a freelancer, if I'm getting paid by PayPal, that's a pretty big chunk of my earnings. And it's a pretty long time to actually get paid. So we thought this is really a perfect opportunity to introduce stablecoins into the flows to basically really tackle the cost and the speed element there, right? And incidentally, we started supporting a company called Golance, and they had payment flows into the Philippines. And so we decided to start with the Philippines as our first market and really try to bring those advantages to Golance and then eventually right to the actual freelancers that are getting paid through Golance. And we started with the Philippines. We've expanded from there over time. So we started from there with Southeast Asia, added on China, Hong Kong, Singapore, South Asia. And then from there, we've moved on to Latin America and Africa. But the kind of core flow has remained mostly the same, right? So if we take an example today, we're working today, for example, with a company called Decaf. They're a fantastic neobank that uses self-custodial wallets and stablecoins, the core building blocks of their app. And so they're providing dollar access in the form of USDC to their users. But then whenever those users want to repatriate funds back to their local currency, so there's a big focus on Latin America, but it's also available beyond that in markets like Africa and Asia, they will use us to actually do that off-ramp into the local currency through to a bank account, right? And so if you think about the flow and how it gets broken down step by step, Decaf will issue a self-custodial wallet to the user when they onboard. That user can be paid in a stablecoin like USDC, or potentially they can on-ramp from a local currency to USDC and basically get the benefit of holding a more stable asset in the form of a US-backed stablecoin. They can then get access to certain products like yield through DeFi, but generally speaking, they will have some form of yield on a stable dollar asset, which is a huge kind of value that they're providing to their customer. And then whenever they want to cash out essentially to pay for their own living expenses and so on, Decaf will basically hit our API, send those funds in the form of USDC to our smart contracts. And then from there, we will be able to do the final payout, the final mile delivery into the bank account in that local currency, right? So whether that be Colombian peso, Mexican peso, or INR in India, we would be supporting that kind of last mile conversion and delivery into a bank account through that same API endpoint.
It's really interesting. So that final FX, from a commercial standpoint, is that where you guys like to monetize the service in that flow? Is that typically how you approach it?
Yeah, so we have a few different components. The primary one is on the transaction, right? So there's a FX component, a orchestration component, and that's typically how we make money today. But we also have these bank account products that we can issue, and typically we do charge a little fee for that as well. For us, like, our mission is really to build this next generation infrastructure for money movement. And the way that we achieve that is really by making sure that we can support these types of customers that onboard with us, and that they can really benefit from the cost and speed savings of using that infrastructure, right? So we're trying to drive volume, and ultimately we want to make money by increasing the volume that goes through this infrastructure and hopefully translate the benefits back to the customer that way.
You mentioned earlier this idea of, you briefly touched on this, but I thought it was really interesting that you said that this idea of stablecoin yield and the idea of actually baking in the idea of holding maybe a specific stablecoin, or I don't know if this is something that Walipe issues or works to issue in partnership with other companies, but like, I would love to know more about what you meant by that, because when you think about the incentive systems that you're building, that's always very interesting to me to understand. Of like, in my mind, the stablecoins themselves have such an opportunity to not only be, from a settlement system, faster and cheaper, but a store value system to be on the tail end of that, just in an incredible way to accumulate value over time within that wallet that you're talking about. So what did you mean when you said that? What does that look like today?
Yeah, that's a really good point. I think a lot of people have a tendency to think of stablecoins as purely a payment token, but actually a stablecoin should be seen as a financial instrument, right? Because what it ultimately is at the end of the day is a representation of underlying assets, which are typically US treasuries being held in a bank account somewhere. And so that is a financial instrument that has more than one benefit, in this case of the payment, but it can also be, like you said, used to store value. Now, with Circle and Tether, when we talk about that stored value for the end customer, it's really access to a dollar that is stable. But generally speaking, the customer is not benefiting from the yield of those underlying assets, right? But we're starting to see that change quite a bit with new stablecoin issuers who are starting to share that underlying yield with their customers and their customers' customers, right? And so we work with different partners to make that happen. So we work with Paxos, we work with Bridge, and there are other interesting companies that are doing similar things like Braille, where they are enabling a fintech player or some kind of company to basically tokenize their own deposits and actually get directly access to the yield from those underlying deposits, right? And that's opening up a whole new way of actually monetizing for whether it be an end business or a fintech, right? That's an extra source of revenue for them. And because this is all built on programmatic stablecoins, it's really easy to then create rules around revenue share and who gets access to that yield, whether you pass that along all the way through to your end customer or whether you keep some for yourself. And that's exactly what companies like Decaf and others are doing. And it's really a whole new way to think about fintech and how neobanks work and make money.
I feel like we're about to enter a very exciting time for that specific part of this conversation. What would be your advice or your perspective on working with some of those companies that you mentioned, like Braille, Paxos, Bridge, very companies that in my view are leading the way in many ways in this conversation? What has been your experience working with them? Do you work with them differently? Like, are there certain things those companies do well in your mind versus others? Is it for you just a redundancy, working with multiple? There are probably a lot of founders thinking about that right now. So any perspective on that would be interesting.
Yeah. So first thing is, I would say we work with all of them. And I would encourage anyone to speak with all of these different organizations and see what makes the most sense for their own use cases. Because while on the face of it, a lot of these companies are offering the same type of product, under the hood, there may be some pretty different configurations in terms of where those assets are held, what are the licenses that these participants are leaning on. And depending on who you are serving as a customer, that's going to be really important to get a handle on, right? Especially in terms of who is the actual custodian of those funds and what kind of licenses those custodians have, whether or not the funds are being held in a bankruptcy remote a company, whether or not that's on or offshore. The devil's in the details with this kind of product. And it's super important to be aware of all of those nuances when you're looking to build on top of that infrastructure, right? And it should really be driven by what kind of use case you are building for and what kind of customers you're building for.
Yeah, that said, are there, I know I'm drilling a level deeper here, but are there certain use cases or certain customers that you find are better? Not that you're putting your stamp of approval on any of these folks, but I think it's important to really help people understand how to think about those use cases, like the custody models of them, the licensing or non-licensing models of them are so unique. Like, maybe even just one example of, like, from your perspective, what something like a Braille or Paxos or Bridge would be great for versus something that wouldn't be great for. Just that would be interesting if you have any perspective on maybe one example there.
Yeah. So maybe I can speak to two. I think one of the things that Bridge has done so well is from the beginning really building for developers, and all of the products that they have built, starting obviously with the kind of core on and off ramp product, but then layering on things like the virtual accounts that they have, the custodial wallets, and so on. Everything has been really built from that perspective of supporting developers. And so if you're already using Bridge for different on and off ramping flows, they've made it really easy to then park some of those deposits that may have been USDC into their own stablecoin and automatically have those flows or those revenues basically shared with you, right? And so that's a model where if you're already building on that kind of infrastructure and you have less requirements around who's actually holding the funds and whether or not you can move them out of those wallets, it's a really good fit, I think, in that case for you to basically work with a company like Bridge to get access to some of those revenues. Now, on the other hand, we're working with a fairly large PSP, and with that, we're working with Paxos, and they have different requirements around where the underlying assets are being held and whether you can actually move them out of a given wallet and even use those as potentially some kind of payment instrument, right? So in the Paxos use case, we are working with them to basically convert money coming in into USDG. And basically from there, we can control where that USDG is being held. Potentially it's in a custodial account, but it could potentially also be held in the merchant's self-custodial wallet, right? And so having that kind of flexibility around where the assets can actually move, and then also being able to lean on the fact that Paxos has done a lot of the work to make sure that this is sound from a regulatory perspective, that's supporting a whole different kind of use case. Braille, we have not yet worked with directly, but I know that they're also doing really interesting things in terms of how fintechs especially can use that infrastructure to tokenize their own assets and make sure that's a productive asset rather than just money kind of sitting in accounts, not accruing any additional revenue.
So interesting. We were excited to continue this conversation, and hint, it might be the next topic of our next season, maybe. So thank you for that insight. It's really interesting, and I'm very fascinated to watch that develop more. Give us, as we turn the corner and prepare to close here, just on Walapay, on the future, on what you're building with the customers that you. Maybe a closing question could be, compared to the customers that historically you've been working with, and you think about what's worked in the past. When you think about the future and what gets you really excited about the customers that are partners that you want to be working with and building with, what for you are the top, really the top priorities, the customers or companies you want to be onboarding to this platform, use cases you want to unlock? I know this is a very broad sort of ending question, but what is the really top of mind goal here for you as you move into the new year?
Well, look, I think it's always important and helpful to take a step back and acknowledge that while we've made a lot of progress, 90% of B2B payment flows globally are still happening through banks. Okay, so we're starting to make a dent, and I think stablecoins have very obvious benefits, but it's still really just scratching the surface, right? It's very early days in terms of the actual volumes that happen globally speaking, right? And so what gets me excited is actually thinking about just that, what that means in terms of the opportunity, right? We've been working with a lot of really forward-thinking, pioneering types, whether it be businesses that have specific payment challenges or new types of fintechs, new types of models that are emerging that are built on stablecoins, or some of these PSPs who are recognizing certain narrow benefits that stablecoins can bring, especially in terms of settling flows instantly and offering new product types to their customers. But we're still working with those early adopters, right? To be able to really bring on a lot more volume and a lot more customers onto these rails, we're going to have to start getting more of these financial institutions and banks actually using these rails directly. There's been a lot of friction from a regulatory standpoint, especially in the US around this, that have been essentially preventing some of these financial institutions to get involved. We're starting to see a lot of change happening in the US. That was preceded by change in Europe with new frameworks like MiCA. In some ways, those are adding obstacles, but in other ways, they're really clarifying what the lay of the land is so that financial institutions can start getting comfortable using these rails, right? And so what we want to do is get more and more of these banks FIs and fintechs onto these rails so that we can really start collapsing a lot of the layers of intermediation and complexity and abstraction that we've had to build to basically connect the banking rails and the stablecoin rails, right? Ultimately, we should be trying to collapse a lot of that infrastructure to reap even more benefits from the speed and the cost advantages and the access advantages that stablecoins can bring us, right? So by bringing more of those types of users and participants into these networks, that should ultimately translate to lower costs and better experiences and speed to the end customers that are ultimately sending and receiving money on these rails.
Sort of a spicy question as we end. When you even use the word collapse, like collapsing these things into the new flow that you're describing, what is the sort of wreckage of that? Like what companies, what business models or pieces of the traditional flow in your mind? Because there are companies in the liquidity side of these partners that are still incredibly crucial to what you're talking about, but I'm imagining there are some counterparties that are currently eating a lot of the cake here that in your mind, if what you're saying happens, are sort of going to be left behind in a sense. So I'm curious if you have an idea of who's most at risk if what you're describing actually happens or continues to happen.
Yeah, it's a fair question. I think for anyone who's built in payments, especially cross-border payments, it's pretty clear that there are just so many layers of intermediation. Even when you like work with a big kind of cross-border infrastructure provider, under the hood, they're probably working with dozens of different types of providers that are kind of adding these little layers of the infrastructure. And that's what I mean by collapsing, is that a lot of this is putting lipstick on a pig, or like putting together these clunky bits of infrastructure that are a product of just how the global kind of banking rails work, right? And so we definitely think that while that has been built that way because it's path dependence in a way, right? Like you started accumulating these layers and layers of infrastructure because of how originally things were built, right? There's now this huge opportunity to collapse a lot of that and actually get rid of a lot of those intermediaries that are providing kind of these little point solutions along the way. So I think they're sure the most at risk, but I think this opens up a huge amount of opportunity, right? When you think about it, like there's about $190 trillion of cross-border money flows, about $4 trillion at any point in time of value that's locked up in funding accounts, essentially that enable a lot of cross-border trade. That's money that should be, it's value that should be opened up for new kinds of opportunities and new financial tech that can be built on top of those rails, right? So in some sense, yes, we do see a lot of collapsing of some of the intermediaries, but on the other side, there's a lot more opportunity to build.
This is really fun. I appreciate your insight and just the way that you've really been thoughtful during this time, just how you approach thinking and being so objective, and how you lead the business and think about the space. It's been really, I've learned a lot through this conversation. Any final thoughts for the listeners about you, Walipe, the future? What do you want to leave the listeners with?
Yeah, it's a great question. I would encourage any of your listeners to come check us out at walipe.io. And really, for anyone building in fintech, there's just a lot of new kind of models that you can lean on when building on stablecoins. And if you have any ideas in that space and are looking for someone to speak with and just brainstorm with, definitely feel free to give me a shout. I'm on Twitter, I'm on LinkedIn, and I'm very responsive. And we, at the end of the day, really want to enable both fintechs and PSPs that have these kinds of problems and have these kinds of ideas to really build on top of these new foundations.
Awesome, man. Well, Tom, thanks for the time. And we'll have to do it again sometime. Just fun.
Awesome. Thanks for having me, Drew. Really appreciate it.